Welcome back to the Investment Committee. Today, we've got a brand new explainer, and we're going to do something I absolutely love. We are putting on our Warren Buffett hats and conducting a rigorous value investing analysis of Kontoor Brands based entirely on their freshly released Q1 2026 earnings data and filings. Okay, let's dive right into this. Kontoor Brands, ticker symbol KTB, just had a really fascinating quarter. They beat revenue expectations, the stock price soared, but they also missed some key earnings estimates and dropped an absolute bombshell about one of their core brands. We need to cut through all that noise and figure out, is this a wonderful business currently trading at a fair price?
Here's the roadmap for today's explainer. First, business and moat. Second, financial analysis. Third, valuation models. Fourth, margin of safety. And finally, the verdict. Let's get to it.
Kicking things off with part one, business and moat. We need to understand their core competitive advantage.
So we are actually watching a massive strategic pivot unfold right now. Kontoor Brands is a lifestyle apparel company that spun out of VF Corp back in 2019. Historically, they've been known for two giant global denim brands, Wrangler and Lee. But their Q1 2026 filings reveal a major shift. They are actively divesting the Lee brand. Why would they do that? Well, they're trimming the fat to align their portfolio toward a much higher growth profile. They want to focus intensely on their outperforming Wrangler brand and their premium outdoor brand, Helly Hansen. Now, the crucial question, do they have an economic moat? Looking at the evidence, we'd assess their moat as narrow. They definitely have solid brand loyalty in the denim space. I mean, Wrangler just grew global revenue by 4% year over year to $436 million. However, this is consumer discretionary apparel. Switching costs are inherently low. You can easily just go buy another brand of jeans. But where Kontoor truly shines is in its management quality. They are incredibly shareholder-friendly. They just authorized a massive $750 million share repurchase program, and they maintain a rock-solid 53-cent quarterly dividend. Let's run this through the classic Buffett checklist to wrap up our qualitative look. Understandable business? Yeah, they make and sell apparel. Durable competitive advantage? It's narrow, relying almost entirely on brand strength. Consistent returns? Historically, growth has been a bit sluggish at around 8% annualized, but recent constant currency growth is definitely showing promise. And finally, able and honest management? The absolute transparency around shedding the Lee brand, combined with aggressive buybacks and dividends, points to a highly rational, shareholder-aligned management team.
Moving into part two, our deep financial statement analysis. Let's look at the raw numbers for Q1 2026.
Looking at the income statement, Kontoor just posted a massive 29.7% jump in total Q1 revenue, hitting $808 million and easily beating Wall Street estimates. But here's the catch. Operating margin stayed perfectly flat at 11.2%. This tells us that while they're selling way more product, they aren't necessarily passing higher operating expenses onto consumers to expand their profitability. Furthermore, their adjusted earnings per share came in at $1.06, which actually missed analyst estimates of $1.14 by about 7%. So we've got an explosion on the top line, but a bit of a squeeze on the bottom line. Next up, the balance sheet. And we have to check this because as value investors know, debt can absolutely wreck an investment. Kontoor ended the quarter with $2.65 billion in total assets, including about $463.5 million in inventory. But the giant flashing light here, the leverage. They are lugging around $1.14 billion in long-term debt against just $56.4 million in cash and equivalents. That is a heavy, heavy debt load for a consumer discretionary company. Though they do note they have nearly $500 million available on a revolving credit facility if they need liquidity. What about cash flow, the absolute lifeblood of owner earnings? Well, we're seeing some real contraction here. Operating cash flow fell from $77.6 million a year ago down to $46.2 million this quarter. At the same time, capital expenditures for property and capitalized software crept up slightly to $8.3 million. The result, their free cash flow margin took a serious hit, dropping from 12% all the way down to 4.7% year over year. We absolutely have to watch this because free cash flow is exactly what pays for those generous buybacks and dividends we love so much. But despite the Q1 earnings miss and that cash flow squeeze, management is actually projecting a ton of optimism. They just raised their full-year adjusted EPS guidance to a midpoint of $6.65. That's a 3.1% increase. They also bumped full-year revenue guidance up to $3.44 billion. This really signals strong internal visibility and a lot of confidence in their ongoing operations for the rest of 2026. To sum up the financials, capital allocation is definitely their superpower. They returned $54 million right back to shareholders in Q1 alone, including $25 million in pure stock repurchases. Plus, they recognized a $54 million tariff refund receivable from a recent court ruling, which is a fantastic future cash catalyst. Now for the red flags. We already mentioned it, but that $1.14 billion debt load is substantial. And honestly, the messy discontinued operations accounting stemming from the Lee divestiture makes figuring out their true normalized long-term earnings a bit of a headache right now. Let's shift gears to part 3, valuation models. Time to calculate some intrinsic value. If we're building a discounted cash flow, or DCF model, we kick off with management's guided base revenue of $3.44 billion. Now, since long-term terminal growth rates and the weighted average cost of capital aren't just handed to us in the quarterly press releases, we, as analysts, have to make some educated assumptions. We'll conservatively assume a terminal growth rate of 2 to 3% to match long-term GDP. We derive the cost of equity from the current risk-free rate plus a standard equity risk premium. Finally, we project out our free cash flows, assuming they normalize somewhere between that recent 4.7% dip and their historical 12% margin. We also can't ignore the classic Graham intrinsic value formula. Value equals EPS times 8.5 plus 2 times expected growth multiplied by 4.4 divided by the current AAA corporate bond yield. Plugging in our numbers, we'd use that $6.65 adjusted EPS guidance, a standard 4.3% forward growth estimate from sell-side analysts as our G, and today's current AAA bond yield. We don't need to do all the live mental math right here, but applying these standardized models gives us an anchor, a baseline for what the company is truly worth, completely independent of whatever mood the market happens to be in today. So what is the market thinking right now? The current stock price for KTB sits at $73.65. However, based on the models from 11 institutional analysts, the consensus price target is $99.70. You guys, that implies a nearly 41% upside from the current trading price. The street clearly believes that shedding the Lee brand and leaning heavily into Wrangler and Helly Hansen is going to unlock some massive value. Which brings us perfectly to part 4, the margin of safety. We always have to protect our downside risk. Let's map out our valuation range. The current price is down at $73.65. The consensus target is right around $100. You've got UBS coming in with a wildly optimistic high target of $131. But honestly, I love looking at the bottom. Stifel has the lowest analyst target on the street at $80. The fact that the stock is currently trading below even the most pessimistic Wall Street estimate provides an incredibly compelling starting point for our margin of safety. Let's do the math. If we take that $99.70 consensus intrinsic value target and mandate a strict 25% margin of safety discount, which is a classic Buffett-style hurdle, it yields a maximum buy price of roughly $74.77. And since the current stock price is $73.65, well, look at that. Kontoor Brands is actually sitting safely right inside our calculated buy zone. All right, part 5. Time for the final verdict. Buy, hold, or pass. Here is the thesis to take back to the committee. Kontoor Brands possesses a narrow economic moat, driven by Wrangler's brand loyalty, paired with a fiercely shareholder-friendly management team that is aggressively returning capital through a massive $750 million buyback program and robust dividends. By cutting the underperforming Lee brand loose, the company is effectively streamlining itself into a higher-growth, higher-margin profile. And the absolute kicker? Despite carrying a heavier debt load, the current market price offers an entry point that is fully within our required 25% margin of safety. So, I'll leave you with this final thought to chew on. Taking everything we just covered today, the fundamentals, the strategic pivot, the raw math, is Kontoor Brands a wonderful business at a fair price? I've laid out all the facts. Now, based on your own portfolio strategy, is this a buy, a hold, or a pass?